Imagine holding an asset for 15 years, watching it grow from pennies to hundreds of millions of dollars, and then suddenly deciding to sell everything at once. This week, the crypto market watched in absolute terror as a Satoshi-era whale woke up from a 15-year slumber and dumped 9,500 Bitcoin, worth over $670 million. Almost immediately, social media algorithms and mainstream financial outlets began screaming that the smartest money in the room was capitulating. If the original pioneers are abandoning ship, the entire digital gold thesis could be facing a catastrophic liquidity crisis. My name is Lewis, and you're watching The Coin Bureau. So, does this ancient insider know something terrifying about the market that we don't? Is this the start of a cascading liquidation event? Or is the on-chain data hiding a completely different reality? Stay tuned to find out. But to begin with, let's look at the blockchain data that triggered a wave of extreme fear across the market. In early March 2026, blockchain tracking services like Whale Alert began flagging massive movements from a cluster of long dormant wallets. These addresses contained the cryptographic fingerprint of the Satoshi era, utilizing the original pay-to-public key or P2PK address format that was standard back in 2009 and 2010. Collectively, these ancient wallets moved 9,500 Bitcoin in a matter of days. At current market prices, that is a $670 million supply shock hitting the ledger all at once. And the timing of this awakening could not have been worse for retail sentiment. Bitcoin had just dipped below the $66,000 level, caught in a broader macroeconomic rotation that had traders bracing for further downside. The Crypto Fear and Greed Index had plunged to a reading of 12. Yes, 12. That is a level of extreme fear that we have only seen 3 other times in the entire history of this asset, including the March 2020 COVID crash and the November 2022 FTX collapse. When the Whale Alert notifications hit Twitter, the psychological impact was profound. Retail investors suffered from a behavioral bias known as the representative heuristic. They assume that a 15-year-old holder must possess some kind of insider knowledge about the network's future. They see a Satoshi-era whale moving coins and immediately assume it is a representative signal of an impending market crash. The illusion of the HODL forever myth was shattered in real time. According to data from Santiment, social media mentions of capitulations spiked, and smaller traders began panic selling their bags into an already bleeding market. The mainstream narrative is clean, simple, and emotionally compelling. The problem is that it is only looking at half of the picture. Because, as always, the headline panic is completely missing the actual mechanics of how a trade this large is actually executed. You see, when you're moving nearly $750 million, you do not simply click sell on Binance. With sums like these, things work a little bit differently. Because if a whale were to market sell 9,500 BTC on a public exchange, it would trigger absolute carnage. To understand why, you only need to look at the actual order book depth on the world's largest crypto exchange. At peak trading hours, the visible liquidity on Binance within 10 basis points of the mid-price is roughly 3.86 million. Even if you expand that out to a full 1% of market depth, there is only about 400 million to 600 million in resting bids. A single $670 million market sell would literally consume the entire visible bid side liquidity of the exchange. Every single order filled would force the price lower, meaning subsequent coins would sell at progressively worse prices. This is textbook slippage, and it would trigger a cascading liquidation event across the derivatives market that would crash the price of Bitcoin by double digits in minutes. But that is not what happened. Forensic on-chain analysis reveals that these 9,500 coins did not hit retail order books to be dumped on the open market. Instead, the transactions were structured, consolidated, and routed into institutional over-the-counter or OTC desks. Here's how it works. An OTC desk is a specialized financial service that facilitates massive block trades directly between two parties, completely bypassing public exchanges. There are 2 primary types of OTC desks operating at this scale. First, you have principal desks, like Cumberland DRW, which act like wholesalers. If a whale wants to sell 9,500 BTC, a principal desk buys it using its own multi-billion-dollar balance sheet first, taking on the price risk, and then quietly redistributes it to buyers later. Second, you have agency desks like Falcon X, which act like high-end matchmakers. An agency desk sources buyers for the whale's coins across a global network of sovereign wealth funds and institutions without putting its own capital at risk. In either scenario, the desk uses a request for quote system to lock in a guaranteed execution price for the entire block. The trade executes off book entirely. There is no exchange footprint. There is no order book slippage, and there is no flash crash. And in 2025 alone, Falcon X crossed $1.5 trillion in institutional volume using exactly this model. So, the fact that a $670 million Satoshi-era dump was absorbed so quickly indicates that there was a massive hidden bid sitting just below the surface of this market. The whale didn't crash the market. They simply transferred their supply to a new class of institutional holders. And speaking of tracking these institutional mechanics before they hit the mainstream headlines, this is exactly why you need the Coin Bureau Telegram channel in your life. That is where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates. All pinged directly to your device so that you don't miss a thing. Whether it's on-chain whale movements, hidden OTC routing data, or macro signals flashing before the broader market reacts, our members see it first. So, sign up today using the link down below or by scanning the QR code on the screen. Now, back to the hidden truth about who's actually buying these ancient coins. Let's now take a look at the exchange-traded fund or ETF complex to get an idea of the sheer scale of the institutional appetite absorbing this sell pressure. Since the launch of the US spot Bitcoin ETFs, the market structure has fundamentally transformed. Total Bitcoin spot ETF assets under management now sit at a staggering $88.9 billion. BlackRock's IBIT alone controls over $53 billion of that total, representing nearly 60% of the entire market share. But it is not just the size of these funds that matters. It is the creation and redemption mechanics that sit underneath of them. In July 2025, the SEC quietly approved in-kind creation and redemption for spot Bitcoin ETFs. This was a massive structural shift. It meant that authorized participants, the mega banks like Jane Street, JP Morgan, and Citadel, could now deliver actual Bitcoin directly to BlackRock in exchange for ETF shares. When a whale dumps 9,500 BTC and causes a momentary dip in the spot price, these authorized participants have a massive financial incentive to step in. They buy that discounted Bitcoin through OTC desks and use it to create new ETF shares, pocketing the arbitrage difference. This creates an automatic, multi-billion-dollar shock absorber for the market. Just look at the daily volume numbers. On a normal trading day in 2026, BlackRock's IBIT routinely processes between $2 billion and $3 billion in volume. On the exact day that this Satoshi-era whale moved their $670 million stack, IBIT alone processed $2.84 billion in flows. That means that this historic whale dump represented less than 24% of the daily volume of just one single ETF. To the algorithms and the retail traders, 9,500 BTC is a catastrophic event. To Wall Street's ETF plumbing, it's a rounding error. And now, cast your mind back to September of 2018. Bitcoin was already suffering through a brutal crypto winter when a single whale with no previously recorded transactions transferred 22,100 BTC onto the open market. Because there was no ETF infrastructure, no regulated OTC depth, and no corporate treasury buyers, that single dump helped cascade the market into an 80% collapse. Or look at the Plus token Ponzi scheme liquidation in 2019, where the dumping of roughly 200,000 BTC depressed the entire global market by 20% for 4 months straight. The market back then was a fragile, retail-dominated ecosystem with zero structural support. But compare that to what happened in July of 2025. The market faced its ultimate test when a single Satoshi-era whale transferred 80,000 BTC, worth a staggering $9.3 billion in a single day. It was the largest notional Bitcoin transaction in the history of crypto. If that had happened in 2018, Bitcoin would have gone to zero. But in 2025, Galaxy Digital orchestrated the entire sale through its OTC desk, matching the seller with sovereign wealth funds and institutional asset managers. The price of Bitcoin dipped by just 1.42%. We saw the exact same resilience during the Mt. Gox creditor distributions, where the market absorbed billions in recovered funds with barely a flinch. So, this event exposes a massive structural shift in how Bitcoin absorbs supply shocks today. We are witnessing the final, irreversible transfer of coins from the early cypherpunks and miners directly to Wall Street and traditional finance. According to Glassnode, long-term holders currently control roughly 14.47 million BTC, which is about 72.7% of the entire circulating supply. As these ancient coins wake up and are sold, they're resetting the realized cap of the entire network. An early whale selling Bitcoin they mined for pennies to an institutional buyer at $70,000 a pop permanently transfers that unrealized gain into a new, higher cost basis. And these entities buying these bags are not retail day traders. They are corporate accumulators who view these dips as generational buying opportunities. As of March 2026, 84 publicly traded companies hold a combined 1.13 million BTC on their balance sheets. Strategy alone has amassed an incomprehensible 738,731 Bitcoin, acquiring over $1 billion worth in a single week this March. So, while it is emotionally jarring to see an OG whale exit the ecosystem, it actually distributes the supply more broadly among regulated, well-capitalized entities. The true signal here is not the fear of the seller. The true signal is the staggering, insatiable appetite of the buyer, who quietly absorbed $670 million in a single day without breaking a sweat. Now, a Satoshi-era whale selling 9,500 Bitcoin is a historically significant event, but it is absolutely not a bearish macro signal. The on-chain data proves that this was not a panic dump onto retail order books, but was a highly orchestrated OTC transfer to institutional buyers. The fact that the market absorbed a $670 million supply shock without a fuss proves that the liquidity infrastructure of Bitcoin has fundamentally matured. The early pioneers are taking their profits, and Wall Street is eagerly buying their bags. The illusion of the HODL forever myth may be shattered. The infrastructure of the network has been tested, and the digital wealth of the cypherpunks has been permanently transferred. Let's hope that those OGs are having fun spending their riches. Meanwhile, retail investors who panic sell based on whale alert headlines are simply handing their supply over to the very institutions they're trying to front-run. But what do you think? Are OG whales selling a sign of a market top, or just a healthy redistribution of supply to institutions? Let me know your thoughts in the comments down below. And if you want to see how ETF outflows are masking massive whale accumulation, well, you could check out our video on that right over here. And if you want to understand how corporate treasuries are building a permanent floor underneath the Bitcoin price, well, you could check out our video on that right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.